Welcome to Rich Tribe. Look, if you've ever wondered how the ultra-wealthy just quietly build and protect generational wealth, while the average person is out there struggling just to beat inflation, you're in exactly the right place. Today, we're completely breaking down the ultimate insider playbook on asset allocation.
Okay, that's a pretty massive promise, Richard. I mean, most people out there think getting rich is literally all about picking the next Apple or finding the next Tesla.
And that, Rachel, is exactly why most people never actually achieve true financial freedom. In this explainer, we're going to show you how to stop gambling and start architecting your wealth like a family office. Stick with us until the end because the strategies we're about to reveal are going to completely change how you view your portfolio and, honestly, your entire future.
So let's kick things off with a number that's going to totally shatter how you think about investing. 93.6%.
Okay, I'll bite. What exactly does 93.6% mean?
Well, it comes from this landmark academic study on massive pension funds, and it turns out 93.6% of a portfolio's performance and its volatility over time is determined by just one thing: asset allocation. It's not stock picking, it's not timing the market, it is purely asset allocation.
Wait, no way. You're telling me that obsessing over choosing individual stocks accounts for less than 7% of the impact? That's wild. Because the entire financial news media is basically built on telling us what specific stock we absolutely need to buy today.
Exactly. The media sells hype to the average man, but the wealthy, they buy structure. If you want to build real, lasting wealth, you've got to master the two pillars making up that 93.6%: strategic and tactical asset allocation.
So here's the actual blueprint. First up, we have Strategic Asset Allocation, or SAA. This is your long-term, completely environment-agnostic plan. You figure out your ideal mix of stocks, bonds, real estate, and you just hold it. It doesn't matter what the economy is freaking out about today.
Right, and then the other side is tactical asset allocation, or TAA. Active, capitalizing on perceived gains. So this is where we're actually making our moves.
Spot on. TAA is what allows you to actively pivot away from your strategic baseline. You use it to capture those short-term opportunities or maybe dodge some immediate risks in the market.
I mean, that sounds a bit like textbook financial jargon, Richard. How do we actually visualize this in the real world? Like, how does a millionaire picture this when they're looking at their money?
Okay, let's dive into this. Picture your strategic asset allocation as these massive, deep, unshakable roots.
Got it. So the roots really don't care if it's raining, storming, or totally sunny on any given Tuesday.
Exactly. They are the absolute foundation. A strategic allocation is built to weather decades of economic cycles. It balances your long-term risk and return. You set this foundation based on your goals, your age, your ultimate wealth target, and you just let it ground you. You definitely don't dig up the roots every time the stock market has a rough week.
But you can't just be roots. Think about a leaning tree reaching out over a gorge. That reaching, that is your tactical asset allocation.
So while the roots keep the whole tree from falling over, the branches are actively stretching out toward the sunlight?
Precisely, Rachel. Tactical allocation is completely opportunistic. It's the dynamic edge of your portfolio. If a specific sector drops in price temporarily, or there's some sudden macroeconomic shift, your tactical branches reach out to capture those immediate, perceived market gains. But here's the catch. A tree without deep roots that reaches way too far over a cliff, it's just going to pull itself straight down into the abyss. Okay, so if the rules are this simple, build deep roots, reach for sunlight, why isn't everyone wealthy? Why does the average investor consistently fail at this? Well, that's because of the single greatest threat to your portfolio. Which brings us to part one, defeating your own mind, the psychological traps of wealth.
The average investor is completely paralyzed by three wealth-destroying biases. First up is conservatism. People naturally overvalue the stocks they already own, and they totally refuse to accept unrealized losses. They just hold on to losers hoping they magically bounce back.
Oh, wow. I've definitely been guilty of that one. What about anchoring?
Anchoring is when you fixate on past prices instead of current data. You think, well, the stock was at $100 last year, so $80 is a total bargain, even if the company's fundamentals are literally collapsing in real time.
But wait, isn't chasing the news exactly how people find the next big tech stock? How does availability play into this?
That is the ultimate availability bias trap. It's the tendency to chase flashy news, basically whatever's most easily available to your brain, rather than sticking to your strategic roots. The average man falls for hype. The wealthy stick to strategy.
And that brings us to what is probably the most insidious trap of them all, mental accounting.
Treating separate portfolios individually. Why exactly is that an illusion?
Because people put their money into mental buckets. They think, all right, this is my safe retirement money, and over here, this is my fun crypto trading money. But by separating them, you become totally blind to your true net worth and your overall risk exposure. You might be taking massive, irrational losses in your fun account that are secretly wiping out all the strategic gains in your safe account. The wealthy, they always look at their total aggregated picture.
Okay, Richard, I really want to see the receipts here. How do actual millionaires apply this today? Let's open up the Insider Playbook, Part 2, the Family Office Playbook, how the ultra-wealthy actually invest.
Historically, family offices kept their strategic allocations pretty stable, but recent data shows a major tactical shift right now. They're heavily increasing their equity and risk assets.
Wait, why are they taking on more risk in such an uncertain macroeconomic environment? That feels backwards.
Because they're making active, conviction-led tactical shifts. Research from Capgemini and UBS found that ultra-high net worth individuals are currently shifting toward risk assets, like equities, to aggressively combat inflation and uncertainty. They're using their tactical flexibility to go on the offensive, while the average investor is out there panicking and just sitting in cash.
All right, that's the big macro view, but give me an actionable example. How can the average man actually use a tactical play right now to gain an edge? Let me walk you through a brilliantly simple real-world strategy outlined by Mariner Wealth Advisors: tax loss harvesting. Let's say your strategic portfolio holds Coca-Cola, but the stock suddenly drops 10%. Well, most people would just wait for it to recover, right? Because of that conservatism bias we were just talking about. Exactly. But the wealthy tactically sell it. Step 1, you sell Coca-Cola to realize the loss. Step 2, you use that loss to offset your capital gains taxes, which saves you real hard cash. And Step 3, you immediately buy PepsiCo. Oh, wow! So you maintain your overall strategic exposure to the beverage market, but you harvested a tactical tax benefit along the way. That is incredibly smart.
Now check out how family offices are viewing the global map heading into 2026. In a fragmented geopolitical world, this is a major tactical shift.
Okay, it looks like they're slightly decreasing their North American exposure and bumping up Latin America.
Yes, wealth managers use geographic diversification as a massive tactical wealth hack. They don't just diversify across asset classes like stocks and bonds. They tactically shift across borders to lower their concentration risk. They literally never bet their entire generational wealth on just one single region's economy.
With all this complexity and these global shifts, how do millionaires actually sleep at night during violent market crashes? I'll let Roman Berry from Julius Baer answer that one via a recent Adams Street report. Quote, "You don't mark to market on a daily basis, and you don't trade on a daily basis, which smoothens the overall portfolio volatility."
Meaning they aren't compulsively checking their stock apps on their phones every 5 minutes?
Exactly. The ultra-wealthy allocate heavily to private markets, things like private equity, venture capital. These assets aren't priced on a public ticker symbol every single second of the day. It completely removes the emotional panic of daily trading and forces you to stay anchored to your strategic roots. Now, before we wrap up this explainer and I leave you with one final, absolutely crucial thought, we need you to take action. If you want to stop investing like the average person and start building real generational wealth, subscribe to Rich Tribe channel, like, comment, and share.
Seriously, joining the community and engaging with this content is the absolute best tactical move you can make for your financial education today.
So we've broken down the 93.6% rule, the psychological traps that defeat the average mind, and the real playbook of the modern family office. Now we leave you with this.
Is your financial future anchored by deep strategic roots, or are you just swaying in the tactical wind?
It's time to audit your own portfolio. Figure out exactly where your roots are planted, stop making emotional trades, and we'll see you in the next breakdown.